I got to tell you, the nation is still buzzing from that extraordinary student loan relief action yesterday from President Biden. One estimate says it could cost up to $600 billion. And by the way, the total pandemic college forgiveness, because there was already some in place, $800 billion. And not everyone is happy, including prominent Democrats. Jason Furman called it reckless and said it would take 50 to 75 basis point Fed hike to extinguish this disinflationary act. Now, on that note, I thought it was interesting because we saw that, this whole tug and pull between 50 and 75 basis points, it shot up 60%, 75 from 50% at the beginning of the session. Joining me now to discuss, Bianco Research President Jim Bianco. Jim, we have become numb, I think, to some of these numbers, right? I hate to say it, but, 100 billion, 800 billion, it's just like, golly. But the fact of the matter is we're looking at another $1 trillion in federal government spending at a time when the Fed is trying to take down inflation. It just doesn't make sense, does it?
No, it doesn't, because why does the Fed raise rates? They want to curtail spending. They want us to spend less money so that the prices of goods come down. Remember, inflation impacts 100% of the population. So what are we doing? We're giving a certain segment of people with college debt, $10,000 or $20,000. And presumably, what are they going to do with it? They're either going to spend it on things or they're going to put it in a brokerage account and they're going to buy stocks. And that's exactly what the Fed's trying to curtail. We call it financial conditions. They don't want stocks to go up. People feel rich, run to the mall and start spending money because that just drives up prices.
Of course, the big debate also from Wall Street's perspective, investors, is how much the S&P 500 returns depending on just how deep a recession is. Now, I've got a chart up here of history of recessions, like when they start. So this is the line when they usually begin. We always go down into the recession. Then there comes this part where we might be right now. But of course, the major difference, shallow recession, deep recession. Is it too soon to tell where we are within the grand scheme of things?
Well, first of all, I think we are in a recession, full stop, conversation over. Now, I say that because we've always tried to define this word differently. It used to be called panic, then it was called depression, then it's called recession, and now we can't even use the word recession anymore. Yes, it's a shallow recession for right now. We'll see what the next 6 to 9 months brings to see whether or not it becomes something deeper. The stock market, usually when it corrects 20%, and it did in June, most of the time, like 80% of the time, that happens when you're having a recession. And that's another argument for why we might be having a recession. Mm-hmm. If the stock market were to make another move lower towards the mid-June lows of around 3,700 on the S&P, that increases the chances that we are actually in a recession. So that indicator is one that we pay attention to. Like I said, I think we're in a recession. I think it's a very shallow one. But yet I think we have crossed that Rubicon and that, yes, we have one right now.
You also posted a great chart. I say great in the sense that it was mind-boggling, really. Year-to-date total returns for the aggregate bond markets. And golly, I mean, folks, just take a look at this. This is absolutely nuts. This is all the other times. I mean, this is historic stuff. It's actually mind-boggling stuff. So it's the worst by far. What's the implications for something like this, Jim?
Well, what it means is that you're losing money in the bond market. You're losing money in the bond market, which you normally don't do, to a degree that would be associated with a bad year in stocks. You're down 10 or 12%. Now, you've seen that happen. Now, the way you lose money is interest rates go up. And you've seen the implications of that in housing. The housing market seems like it's hit a brick wall with the way that mortgage rates have shot up and the way that housing has been slowing. You've seen it with the stock market. The stock market is dependent on cheap money. Well, money's not getting cheap, it's getting more expensive, and the stock market's slowing. You've seen it with our previous conversation. We might be in a recession right now. So it's had implications. The longer this bond market goes with losses like this, the worse it gets. And unfortunately, with the Fed raising rates, it's not going to turn around anytime soon.
So then let me ask you, because the 60-40 portfolio has been the gold standard for long-term retirement accounts, and it's worked for 4 decades. But, you're looking at the last few years here, and I just want folks to know, so the blue is the 60-40, the yellow is the 80-20. It's outperformed here and outperformed there, outperformed this year, and it's down just a little bit more this year. So, I mean, for the last almost decade, 80-20 was a better combination, but that means more risk. Do you think it's time for people to start considering that?
No, I think that was the last cycle. You're right. 80% equities outperformed 60% equities because through 2020, we had a giant bull market. 100% equities would have outperformed 80% equities if you follow that logic all the way through. Now, if we're in a new era, and I call it the post-pandemic era, of higher inflation, shorter economic cycles. Remember, it was barely 2 years ago that the COVID recession ended. We're talking about whether we're in one right now.
Right.
Then the stock market's going to have lower returns, not negative, not zero, low returns. As interest rates go up, the bond market will give you more interest income, and that will provide you a better Buffett, I think. I think what people have to recognize is complaining that you only had 15% in a year when somebody else had more. You might be lucky to have 10
right.
or 8%
right.
in this environment going forward. And taking more risk, well, you might have a better year here or there, but when things turn bad, it could be much worse.
I hear you, Jim. Great stuff. Really, really great stuff. Thank you very much. Well, Wall Street headed for the hills when the market